Welcome to the Other Side of Wall Street with your host, Ron Harrison.
Good morning, everyone. Welcome to the Other Side of Wall Street. My name is Ron Harrison. I'll be your host. And if you've been following along with us over the past, however many weeks, you'll know that we have been trying to train, educate, and inform you of pretty much all aspects of trading the markets, all markets. We started out earlier episodes pretty much heavily into the trading psychology aspect, which is, for me, I think the most important part of conquering any trading challenges you may be having. And then a couple weeks ago, we switched over to laying down a foundation for options. So before we can really talk to you and teach you about how to trade options, you really need to understand what an option is and how they work. We ended up last week talking about how options are priced. In other words, the components that make up whatever the option is selling for at any given time. And those two components pretty much boil down to intrinsic and extrinsic value. And we wrapped up last week's episode with a fictitious example on Intel, trying to show you how that is all calculated. And I think probably to just jog your memory and catch you up, let's do it again. So the example that we were using was, and this is totally fictitious, has nothing to do with where it's trading now. Let's just say, hypothetically, Intel is trading at $21 per share. Now, the in-the-money $19 call is trading for a premium of $3. But it only has $2 of intrinsic value. So how you would figure that out is, remember, it's trading at 3. So if you took the price of Intel at 21, you subtracted the price of the option for 19, you would see 19 from 21 is $2. So that is the intrinsic value. If it's selling for 3, that means it has $1 of extrinsic value. So again, you would subtract the $19 of the call from the $21 of the share price. 19 from 21, that is 2. And then if the option's trading for 3, that means it has $2 of intrinsic and $1 of extrinsic. So hopefully that jogged your memory. And that's where we left off last week. So to move on, again, let's just say that intrinsic value lets you know what the true value of an option is at that moment in time. That is what intrinsic stands for. Extrinsic is what's left over after you subtract the intrinsic value. So the last 3 items on our list that make up the extrinsic part of the option value is days to expiration, which is the main one. That's the amount of time left till it expires. The current volatility of the underlying stock. So we just gave an example of Intel, so it would be however volatile Intel is at that particular moment, or any stock, whatever stock you're looking at. And then if there are any dividends coming up, because that always has plays a factor in the pricing of options. So again, to recap, the intrinsic value lets you know what the true value of an option is at that moment or any moment in time. The extrinsic value is what's left over after you subtract the intrinsic value. And the extrinsic value is comprised up of mainly how many days there are at expiration, the amount of time left on it. And then secondly is if there's any volatility, how volatile the underlying is, and are there any dividends coming up in the near future on that stock. So an easy way to tell if an option has intrinsic value is to see if you would have any real value if you were to exercise the option. So this would mean turning the option into actual shares of the underlying stock. So all you have to do, so let's say on our example here, for instance, remember we were looking at a $19 call. So let's say that Intel, the share price at that point was only $17 a share. So if you were to exercise the option and buy the stock at 19, that would not have any value because you're paying $2 more than you would pay in the open market. So it would have 0 value. But in our example, Intel was trading at 21, so if you exercised your $19 option, you would have $2 of value. So that's how you have to understand if the easy way to tell if the option has any real value. So hopefully that explains how intrinsic and extrinsic works. It's not really that complicated. It's a pretty simple math problem. So let's move on and talk about another component, which are called the Greeks. So option traders often refer to the delta, the gamma, the vega, and the theta of their option positions. You might hear that on CNBC, on Fast Money, on option, whatever their option show is called. But they refer to those things all the time. You might hear those words. Again, that's delta, gamma, vega, and theta. So collectively, these terms are known as the Greeks, and they provide a way to measure the sensitivity of an option's price to quantifiable factors. So these terms may seem confusing and intimidating to any new option traders, but if you break them down, the Greeks refer to simple concepts that can help you better understand the risk and potential reward of an option position. So what we like to do is try to find the values for the Greeks. And first you need to understand that the numbers given for each of the Greeks are strictly theoretical. That means the values are projected based on mathematical models. So most of the information you need to trade options, like the bid, the ask, the last price, the volume, open interest, all those things, all of those are factual data received from various option exchanges and distributed by whatever service you're using, whatever trading platform you happen to have that you're trading with. So gamma and vega, they're mostly used for floor traders and very active professional option traders. So I think for that, we're not even going to bother to go into those because it's something that you will never use. I just wanted you to know the terms, the words, but you're never going to use those. So it would be pointless to really delve into those things. Now, delta and theta, on the other hand, these Greeks are extremely important for you to know. And they are key indicators that play a huge role in all the option strategies that we'll be covering in future sessions going out pretty far. So, the first one being delta. The delta figure tells us how much the option price will move in relation to a $1 move in the underlying security. So deltas range from 0% to 100%, but you will see them quoted in decimals. So an option contract that has a delta of 0.60 will see its price change 60% of the price change of the stock. So another way to look at it is if the price of the underlying stock goes up $1, then the option with a delta of 0.60 will only increase by 60 cents. So the delta is a very important tool for telling you how your option will perform. And that's also going to be as we go along here, and when we get into strategies. And if you remember back in the psychological episodes, we talked about gamblers and gambler mentality, and we've also touched on the fact that we sell worthless options. We sell options that are far, far out of the money, that are only comprised up of extrinsic value, not intrinsic. They're worthless options. All they have is time value left. That's what we sell because that's what the gamblers want to buy. Remember, they are gambling. They are not investing. They don't want to put up a lot of money. They just want to put up a very small amount in hopes of getting lucky. So we're more than happy to sell them those worthless options and collect the premium, which is totally comprised of time value or extrinsic value. So if you were a savvy investor and you wanted to buy an option to actually make money and have a very high chance of making money, then you would want to buy something with a high delta. So let's say, for instance, if you bought an option that had a 1.00 delta or a 100 delta, 100%, then that would move $1 for every dollar that the underlying stock moved. So dollar for dollar. If it went up, you would profit along with it. If it went down, you would lose along with it. But you would be limited on how much you could lose, which would be the price of the option versus the entire price of the stock. So that would be a much wiser way of doing it. But the gamblers that do not want to spend that much money tend to prefer to purchase an option. Instead of 100 delta, they would rather go down to 10, 9, 8 delta. So if the underlying moves $1, the option is only going to move 10 cents, 9 cents, 8 cents, whichever one they bought. Very small movement. So it would take a tremendously large move in the stock before they would ever see any kind of profit. So that's, again, going back to the psychology. You have to understand the psychology of your customer. And if you understand how they think, it's easy to construct a trading plan that will, I hate to say it, but take advantage of how they're thinking. In other words, the way casinos take advantage of the gamblers. So anyway, let's read through that again. Or go over it. So the delta figure tells us how much the option price will move in relation to a $1 move in the underlying security. So again, an option contract that has a delta of 0.60 will see its price change 60% of the price change of the stock. So another way to look at it is if the price happens to move $1 of the underlying security moves $1, then the option with a delta of 0.6 will only increase by 60 cents. So that's delta. Theta, which is my favorite, the theta figure tells us how much an options premium will decay on a daily basis. So theta is one of the most important concepts for a beginning option trader to understand because it explains the effect of time on the premium of the options that have been purchased or sold. In our case, sold. The further out in time you go, the smaller the time decay will be for an option. So if you want to own an option, it's advantageous to purchase longer term contracts. And that's also a critical part of one of the strategies we're going to get into farther down the road. If you want a strategy that profits from time decay, then you will want to short the shorter term options, which is what we do, so that the loss in time value happens very quickly. So again, remember I said that we sell time. So we sell options. The gambler buys the options and pays the premium to buy them. That premium comes to us. That premium is 100% time value. So we sell something that, let's say, has 7 days of time value. That 7 days, whatever that value is, that's the money we collect. So every day that ticks by, time dissolves. That's the word I'm trying to find. So if we start out with 7, as we go down to 6, 5, 4, 3, 2, 1, each day that goes by shortens the amount of time left, which decreases the value of the option until we get down to where it has no days left and the option value is pretty much 0 at that point because it has no intrinsic value. So basically we sell something and that has some value to it, collect that money, and then it becomes worthless. And that's the end of the deal. That is why the gamblers have such a high percentage level of losing everything they spend, because they are buying these cheap, worthless options, crossing their fingers, hoping to get lucky. And time decays, because that's one thing we can't stop. So every day that time goes by, their hopes get less and less and less until it expires worthless. They lose, we win. So theta is basically represents the time value. And I told you before, we sell time. So another way you can look at it, if you want to sound nerdy, is we sell theta. So that is my favorite delta, because that basically is how we make money. So hopefully that helps explain. And like I said, I told you before, the Greeks are not that complicated, and there's only 4 of them, but we only really care about 2 of them. But just to recap, there was delta, gamma, vega, and theta. So again, when you look at those, the gamma and vega are not important to us at all, so don't worry about them. 2 that we care about are delta and theta. So I know it's a lot of new words, but at least now you're familiar with them and you understand a bit about them. And those 2, delta and theta, will come up many times as we move forward. So we're up against break time now. Let's take a break. We'll come back and continue this.
Here's another look into the world of trading.
Hey traders, want to jumpstart your trading? Well, I would assume that since you're listening to this podcast that your answer would be yes. And as they said in The Godfather, what if we made you an offer you can't refuse? And that's exactly what we're going to do. How would you like it if we gave you all the trades we make in our own accounts in real time so you could trade right along with us and profit as we do? And what if we met once a week for an hour to discuss our current trades, any other trades you may have open, plus discuss any problems you may be having in general with your trading? And that's 1 full hour of group coaching each week. Also, what if we threw in an additional 1/2 hour of private one-on-one coaching each month to privately work on issues you may be having with your trading? It could be things you didn't feel like sharing in the group sessions. Also, what if we threw in a weekly end-of-week market review analyzing the past week's market and what to look forward to for the upcoming trading week? That will be delivered to your inbox every Friday after market close. And what if we threw in a free copy of our latest book, Reprogramming the Trader's Mindset, to help you get your trading emotions of fear and greed back in control? And what if we also sent you our monthly newsletter packed with trading tips and upcoming market events? That would be very useful, I'm sure. And to cap it all off, what if we gave you a 30% discount on all of our live 3-day trading seminars? So altogether, this adds up to $1,269 in monthly value, plus another $1,680 in course discounts to use whenever you like. And if you think all this sounds good, then you must realize that this is a very powerful addition to your trading business. And as with any business, in the beginning, you will need a mentor or support team to help your business grow and to keep you on track to achieve your maximum trading potential. So the small cost to this extensive package is only $49 per month. And of course, you can cancel at any time, but since you will be making far more than the cost of the program by just copying our trades, we doubt you're going to want to cancel. So don't wait any longer. Sign up today. Go to tradersacademy.org. Again, that's www.tradersacademy.org. And do it soon because memberships are limited. And it's our promise to you that if you copy all of our trades and you don't make at least double the first month what you paid, we'll gladly refund your subscription payment. So join us, and together, let's make some money. Okay, we're back. As we before break, we covered the Greeks, and now let's move on to option volatility. And if you remember, we mentioned before that one of the components of the extrinsic value is volatility. But volatility actually plays a bigger part in actually more areas than just that. So let's dive into that for a bit. So, as I said, as we've covered in the past, pertaining to option pricing, we stated that there are several factors that work together to give an option its price. So the largest of these is volatility, and this plays a major role, and it's one of the most elusive and confusing and difficult things for traders to understand. But as a former trader myself, volatility was the basis for all of our trading and profitability through understanding and being able to use volatility to our benefit. Now, volatility is a statistical measure of how erratic a stock has been in the past and how erratic it's expected to be in the future. So understanding past price movements of a stock and its expected price range for the future will help you understand the effects that volatility is likely to have on the price of an option. So volatility levels get inputted into option pricing along with other factors to give the option its price. Now, there's two types of volatility, and you're going to run across these countless times as we move forward. First being historic volatility, and you're going to see that on charts in your trading platform referred to as HV for historic volatility. And this measures how volatile or erratic the stock has been in the past, hence the historic part of that. The second one is implied volatility, and you'll see that referred to as IV. And this measures how volatile or erratic the stock is expected to be in the future. Now, historic volatility, HV, this is based on past price movement of the stock, and it is most often based on a 21-day period, which is equal to one trading month. But it can be based on any time that they want, but typically it's 21 days. What this means is that they collect the closing prices of a specific stock for a specific period of time, and again, usually 21 days, and convert that data into a volatility number to use in the option pricing model. On the other hand, implied volatility, or IV, this is a forward-looking calculation in which the market will make an assessment of how they feel the stock will fluctuate in the future, or at least until the option expires. So implied volatility is considered to be an up-to-the-minute gauge of the mood of the markets. And it not only takes into consideration the past performance, or HV, but it also factors in any other external forces that might move the stock price in the near future. And actually, I think we are going to depend a little more heavily on IV than we will HV. So external forces that can affect the IV, implied volatility. They would be any earnings reports coming up. Let's say possibly an FDA drug approval if it's a drug stock. Federal Reserve meetings, which could affect the entire market, which would encompass all stocks. Or it could affect banking stocks more specifically. OPEC announcements, if you're looking at energy stocks. Unemployment numbers, again, could affect the entire market as a whole. And there'll be many more, but those are just an example of some of the things that can affect IV. And since these are items that can affect the price of the stock, hence the option price will be affected as well. So if the option market makers know that there is a big meeting coming up, they will reprice the options to reflect the uncertainty of the outcome of the meeting or news event. So once the news event is known or resolved, the IV will be readjusted to reflect more normal trading conditions. So what you have to take out of that is any time that there is an event coming up, any of the things we mentioned, and we call them binary events, anytime there's a news announcement, earnings announcement, any kind of announcement, anything coming up, and it's prior to it actually being announced. So in other words, whatever it's coming up is still unknown. It's the unknown factor that causes volatility to increase. So if you've got something possible stock moving, market moving thing coming up in the future, and we don't know what it is yet, that creates uncertainty, which creates higher volatility, which typically increases option prices. So just keep in mind, it's the unknown factor that is doing the work. So the reason why you need to understand that volatility has a much more important part in your option selection and in the timing of your selection as well. And it is because it has a direct effect on the price of every option. So if volatility is high, option prices will be more expensive. And if volatility is low, option prices will be lower. So you want to focus on trying to buy and or sell during the most opportune times. So there's a time for everything. If you really want to capitalize on try to squeeze every penny or every dollar you can out of this. If a stock has been trading very erratically, that in turn will increase the volatility component of the option, and you will see higher option prices. If the stock has been trading within a shallow range, then the volatility component will be low, resulting in lower option prices. So to put this into practical terms, since this course is primarily focused on us selling options to generate income, then we would like to try whenever possible to sell options during higher volatility levels. So the exception to this would be the purchasing of leaps. And that's a strategy that we're going to get into again down the road, where we would then try to purchase these options during lower periods of volatility, because that's when they would be cheaper. And if we're purchasing, we want to buy them when they're cheaper. If we're selling things, we want to sell them when they're more expensive. So we all know that we can't always predict that our timing of our trades will be able to correspond to high or low volatility levels, but you can always tailor your option strategies to take advantage of whatever volatility levels exist at the time. But just understand how volatility affects it, and if you can tailor your purchases, or if you can maybe wait a day or so, it might pay off. So I like to tell a little story I call a tale of two stocks. So as we get into strategies, and remember we've touched on it before, our main strategy is going to be selling options. We're selling options to the gamblers, that's our customers. But when we get to that point and you're doing some trial runs, you might be looking through option tables and you might come upon what I want to touch on right now. So I'm sure once you get there, that there's going to be times that you're going to be looking at several stocks, trying to decide the best ones to place your option plays for the month, the week, whatever you're doing. And you will, without a doubt, find yourself in a situation where you're deciding between two different stocks that are trading for roughly the same price. So as you look at the options for both stocks, you'll find, to your surprise, that the same option on each stock, in other words, the same strike price on each stock, because both stocks are trading about the same price, are trading at very different prices from one another. So again, the stock prices are the same, the strike prices are the same, both expire on the same day. So why are the prices so different between the two? And the answer, of course, is volatility. One stock is probably more volatile than the other. So you're looking at two stocks, same price, same strike prices, same expiration. Everything's identical, except one option price is more expensive than the other. So the one that's more expensive, there's probably something more volatile about that stock or that company. So before you would want to actually place that trade, it might definitely be worth your time to go and research that stock a bit more and find out maybe if there's something coming up, something that is causing that increased volatility, because it might be something that's not good that you might want to avoid. So if you see those two trading at different prices, try to find out why the one is trading a little higher. Now, the other thing is the earnings effect. So in the days leading up to an earnings announcement, the market makers are aware that speculators will enter into the market and start buying up options. So the market makers will start bumping up the implied volatility of the options, which in turn starts making the options price rise a little each day until they're finally priced extremely high on the day of the announcement. So once the announcement has been made, you will experience what's called a volatility implosion, when the volatility of the options gets almost immediately repriced to the lower levels of the pre-announcement period. So this large reduction in volatility brings down the price of the options very rapidly. And again, remember, we talked earlier, it's the known and unknown factor that you have to worry about. So in this case, earnings were coming up, but we don't know what they are yet. So that is the unknown part. So the unknown factor causes the volatility to increase, which causes the price of the options to increase. So how would you profit from volatility implosion? This is some useful knowledge to have and use during earnings season. So during these 4 times each year, you will want to postpone your put selling or your whatever option selling you're doing, until right before the day that the stock that you would be selling options against announces its earnings. So in doing this, you end up collecting a higher premium and see a rapid decrease in the option price right after the earnings is announced. So it's a lot of people, that's all they do, is they make these little trades 4 times a year and do quite well. So remember that lowering or raising the volatility component has 2 different effects on the price of an option. Also remember that 2 different stocks that trade for the same price can have very dramatically different option prices due to the volatility component. And lastly, remember that each individual option within an option chain will have its own volatility value, which may or may not be different from its neighboring options, which means that the entire option chain may not rise or fall at the same rate. So always check the volatility rating on each option before making a decision to take any kind of positions, either long or short. So hopefully some of this stuff is starting to sink in. You're starting to understand more about how options are priced, the components that go into the pricing, the effect that certain pieces of information out there, in other words, earnings reports, dividends, that kind of stuff, has on options. Also, how to maybe use that to your advantage to time your entering into the market, time your selling of options, or even buying, to use volatility to possibly squeeze out a few extra bucks on your trades. Either way, but it's very important that you understand how options work, how they're priced, how they are affected, what they're affected by, and use that knowledge to your advantage. And again, we're going through this stuff, which I know could also be kind of boring after a while, but you need a foundation, because all this stuff later on down the road, when you're actually doing the trades themselves and you're actually constructing the trades, all of this stuff is very important in order to enable you to make wiser decisions and increase your profits. But knowledge is the key. And that's what we're trying to do here. So hopefully some of this stuff is sinking in, and if not, you can always go back and re-listen to these programs and brush up on it. So that's why they're all archived on our website. Listen to them as many times as you need to. So we're getting near the end. Hopefully this was, again, informative and educational. And just want to point out the same thing I mentioned last week. We have a masterclass coming up in January, and we would like to have you attend that for free as our guest. If you would like to join us, all you have to do is go to tradersacademymasterclass.org. That's tradersacademymasterclass.org. Fill out the form, submit it, and you'll get free admission to our 4-hour class, and that normally sells for almost $600. So, chance to pick up a free class. So, if you're interested, again, tradersacademymasterclass.org. Fill out the form, and you're in for free. Other than that, we'll be back next week and with another show, and look forward to seeing you then. Thanks. Bye.